Your phone buzzes at 2:13 a.m. The screen says, "Hospital deposit needed before admission." Your stomach drops because the number is bigger than your salary and they want it right now. You're staring at that message thinking, "I'll figure it out," while your bank app is already shaking its head. By the end of this, you'll know exactly which insurance actually matters, how much to buy without getting played, and what to do tonight so one bad week doesn't erase 5 good years. It's easy to believe insurance is a later problem, because most days, nothing happens. You wake up, go to work, complain about traffic, order tea, and life feels predictable enough. You've survived this long. Your parents survived without fancy policies. Your friend says, "Bro, just save money, insurance is a scam." And honestly, that belief feels true until life gets expensive. Here's see what they don't say. The biggest financial danger isn't the big purchase you planned for. It's the unplanned bill that arrives with a deadline. A wedding expense can be delayed. A phone upgrade can wait. Even a car can be negotiated. But an accident, a sudden hospital stay, a fire, a lawsuit, that stuff doesn't care about your cash flow. It doesn't accept next month. It's a bouncer at the door of your life, and it wants the cover charge now. And there's a sneaky force behind why people ignore this. It's not laziness, it's the optimism tax. Your brain silently charges you a fee for believing tomorrow will look like today. It discounts rare disasters to almost zero, because thinking about them feels dramatic. So you do what humans do. You pay for comfort, not for risk. You buy the sofa, you buy the new watch, you buy the "I deserve it" meal. You don't buy the boring thing that only matters on the worst day. Pause. That's the trap. Let me show you with a tiny story you'll recognize. You're 27, you're earning the equivalent of $120,000 a month. Not bad, you're finally breathing. Rent, $45,000, groceries, $18,000, transport, $12,000, family support, $10,000, subscriptions and random small spending, $8,000. You're saving maybe $20,000 if you behave. You tell yourself, "I'll build an emergency fund first, then I'll do insurance." Sounds responsible. Then one Friday, you're on a bike or in a rideshare. Someone else makes a mistake. You get thrown into a hospital system that runs on deposits like it's a nightclub, emergency room, scans, a minor surgery, 3 nights. Total $380,000. Deposit required $200,000 before they even look friendly. So you do the classic moves. You borrow $50,000 from a friend. You swipe your credit card. You call your cousin who knows a guy. You sell something. You promise yourself you'll pay it back fast. And here comes the villain that keeps showing up in grown-up life, the monthly payment illusion. Because the hospital bill doesn't just cost $380,000. It spawns monthly payments like gremlins, credit card interest, loan installments, missed work days, taxi rides, extra medicines. Suddenly you're paying for that one weekend for the next 18 months. Not because you're weak, because the math is cruel. Monthly payment illusion again, the loan becomes a new permanent roommate. Plot twist, the bill makes its own calendar. Okay, now the math reveal, simple and clean. If you can save $20,000 a month, that's $240,000 a year. Great. But a $380,000 hit isn't a little setback. It's more than a year of savings, and that's if you didn't eat, didn't pay rent, didn't exist. If the bill is $200,000, now it's 5 years of savings in one sentence. Insurance is basically you paying a small, predictable amount to delete a giant, unpredictable amount. It's not magic, it's pooling risk. You and thousands of other people toss small amounts into a bucket. Most months, nothing happens to most people. When something happens to you, the bucket pays. And yes, companies still want profit. So, how do you not get played? You don't buy insurance to make money. You buy insurance to stop your life from collapsing. That's the second villain, the lottery mindset. People buy policies like they're buying a lucky ticket. If I pay, I should get something back. So they avoid pure protection plans and chase complicated bundles with savings, bonuses, and shiny brochures. Meanwhile, the thing that would have saved them, basic protection, gets skipped. Pattern interrupt. Your emergency fund is not your insurance. It's your seatbelt for small crashes. Insurance is the airbag for the big one. Now, what insurance actually matters when life gets expensive? Start with the ones that protect your income and your family from a sudden financial cliff. First, health insurance. Or at least a serious medical cover, not the cute plan that covers up to $50,000 and makes you feel adult. Real cover means it can handle the worst plausible hospital scenario in your city. In many places, a major hospitalization can easily cross $500,000 to $2,000. So you aim for a cover limit that doesn't tap out early, and you check two boring details that decide everything. What is the room limit? Because they'll cap your room and then slash everything else. And what is the copay? Because a 10% copay on $1,000 is still $100,000 from your pocket. Second, term life insurance if someone depends on your income. Term is simple. If you die, your family gets a payout. If you live, nothing happens. That's fine. Living is the reward. This is not for everyone. If no one depends on you, you can skip it for now. But if your parents rely on you, or you have a spouse or kids, term life is the cheapest way to buy peace. Third, disability or income protection if available, because the scariest scenario isn't death, it's being alive but unable to earn for 6 months. That's the gap people ignore, and it's brutal. Fourth, remind yourself insurance. I'm joking. Kind of. That's what I call basic property coverage. Your home contents, your phone, your vehicle, whatever you'd struggle to replace quickly. Not because losing a phone is a tragedy, but because replacement costs hit at the worst time, right when you're already stressed. Now I can hear your inner monologue. I'm young. I'm fine. I don't trust these companies. I'll just save more. And the quiet one you don't say out loud, if something happens, I'll somehow manage. All fair. Let's answer them like adults. Objection 1, I'm young, nothing will happen. Being young reduces risk. It doesn't delete it. Accidents don't check your age, and even if the probability is low, the impact is massive. This is why insurance exists. Low chance, huge damage. You don't build a fire exit because you love fires. Objection 2, insurance companies don't pay. Some are shady, some delay, some reject. So you don't buy blindly. You buy from a company with a track record and a network you can actually use. You read exclusions like you read a restaurant bill when your friend says, "I'll split." You ask, what illnesses are excluded, waiting periods, claim process, cashless options, and you keep copies of every document like you're collecting evidence because you are. Objection 3, I'd rather invest. Good, invest. But investing is a slow game. Even a good return can't protect you from a sudden $1,000 bill next month. Insurance is a shield. Investing is a sword. Try fighting with only a sword while someone throws a rock at your head. Pause. You're not buying fear. You're buying time. Here's a quick micro payoff. The cheapest time to buy protection is before you need it. Because insurers price you like a human body, not like a human dream. You're healthier now than you will be later. You have fewer medical issues now than you might in 5 years. Waiting doesn't make it cheaper. It usually makes it harder. Another micro payoff. The goal isn't perfect coverage. The goal is removing the bills that would force you into debt. If a plan covers the big ticket stuff and leaves you with manageable small costs, that's still a win. Third micro payoff. Once you're insured, you make better money decisions. Because you stop hoarding cash out of fear. You can invest calmly, build skills, take better career moves, and stop living in what-if mode. Now, zoom out. Why does this get worse as life gets expensive? Because your life quietly turns into a small company. You have assets. You have people who depend on you. You have commitments that don't care if you're having a bad month. Your rent isn't interested in your motivation. Your parents' medicine doesn't accept vibes. Your kid's school fee won't pause because you had character development. And the richer you look on the outside, the more the monthly payment illusion hunts you. That illusion isn't just credit cards. It's the way modern life slices big costs into easy installments, so your brain stops feeling the weight. Phone, only $7,999 a month. Bike, only $18,000 a month. Furniture, only $6,500 a month. You stack a few onlys and suddenly half your salary is pre-booked before you even buy food. So when a surprise bill hits, you don't have free cash. You have obligations, and obligations don't bend. And yes, people love saying, "Bro, I have savings." Cool. How much? If you have 300,000 saved, you feel like a superhero. Until you realize a single ICU day can burn through that like it's tissue paper. Not always, but enough that you should respect the possibility. Here's another micro story with numbers, because numbers don't lie even when friends do. Your cousin Santa works in a bank. She's careful. She has 600,000 saved. She thinks she's safe. Then her dad slips in the bathroom. Ambulance, surgery, 7 days, rehab. Total 1,450,000. They didn't ask politely. They asked urgently. Sana drains her savings, then takes a loan, then delays her own wedding plans, then stops investing for a year. Not because she's irresponsible, because the bill schedule attacked her. Monthly payment illusion again? The loan becomes a new permanent roommate. Now the math reveal, part 2, even simpler. Assume you can invest $25,000 a month. In 1 year, you invest $300,000. In 3 years, $900,000 plus some returns. Sounds like you're building armor. But a single 1/500,000 event can delete 3 years of progress in 1 week. Insurance is not competing with investing. It's protecting investing. It's the umbrella so your long-term plan doesn't dissolve in the rain. Now let's get concrete about how much without turning this into a spreadsheet nightmare. For health cover, ask yourself, if you got hospitalized tomorrow, what's the maximum damage that would actually happen in your city? Not the average. The scary but real. Then aim for a plan that covers that, or at least covers most of it. If you can't afford a huge cover, you can mix 2 layers. A basic plan with a decent limit, plus a top-up or an extra rider that activates after a threshold. One-line explanation. A top-up means you pay small bills yourself, and the plan kicks in for bigger ones so your premium stays lower. But only do this if you're stable enough to handle the threshold. For term life, the math is shockingly straightforward. Take your family's essential monthly needs, multiply by 12, multiply by how many years you want to protect. Example. Your family needs $70,000 a month to live without panic. That's $840,000 a year. If you want 10 years of protection, that's $400,000. Add any debts you'd leave behind, like a loan. Now you have a target coverage. No drama, no fairy tales, just math and love. And if you're thinking, that number is huge, good. That's why term insurance is usually cheap compared to everything else you buy to look successful. You'll pay more for a mid-range phone than you'll pay to protect your parents from a financial landslide. Now consider the emotional side, because money decisions aren't made in Excel, they're made in your chest. People avoid insurance because it feels like admitting you're vulnerable, like you're inviting bad luck, as if the universe is listening and taking notes. But reality doesn't work like that. Bad events don't need your permission. They're already on their own schedule. And watch out for social pressure. Your friends will hype the things that shine. New car, new apartment, new gadgets. No one claps for, I increased my cover limit and reduced my copay. But the scoreboard isn't applause, it's stability. Now, the traps insurers and agents use so you don't get cooked. Trap 1. Selling you a tiny cover with a low premium so you say yes. Then when you need it, it runs out fast and you still pay big from your pocket. Trap 2. Hiding restrictions in room rent limits or sub-limits for specific procedures. They'll cover the headline number, then cap the parts that actually cost money. Trap 3. Promising cashbacks and maturity bonuses so you feel like you're winning. Remember, you're buying defense, not a lottery ticket. So when you read a policy, you care about coverage limit, network hospitals, waiting periods. Some plans don't cover certain conditions for a while. Exclusions, what they won't pay for. Copay and deductibles. Claim process. If you can't explain these in simple words, you don't understand the product yet. And if an agent refuses to explain, that's not an agent, that's a magician. Pause line. Never buy from a magician. Now I'm going to say something slightly rude but useful. You don't get financially rich by chasing returns first. You get rich by avoiding massive losses. That's why boring people win. They don't win by magic. They win by not getting wiped out. Let's add 2 more objections I hear all the time. Objection 4. I'll buy it after I finish this loan. If you're paying EMIs, you are exactly the person who needs protection, because you have less flexibility. If a surprise bill hits, you can't pause your EMI. You can only add another EMI. That's how people end up juggling 6 payments and calling it adulting. Buy the protection first, even a smaller one, then upgrade as debt drops. Now, how do you pick without drowning? Use a simple rule. Cover the big risks with the simplest products. Health cover, simple, strong, usable. Term life, simple, strong, no savings attached. Disability accident, simple, clear. Avoid anything that mixes 5 benefits and promises a miracle. Miracles have fees. Now let's make the do this tonight plan even more real with steps. If you're broke or overwhelmed, you do the survival version. Step 1, write down the 3 disasters that would wreck you. Usually it's medical, loss of income, and debt you'd leave behind. Step 2, pick one to cover first. For most people, it's medical. Step 3, set a hard monthly budget for protection. Even $2,500 or $2,500 a month can buy a basic plan in many places. Step 4, stop buying tiny luxuries for 2 weeks to fund it. Yes, I'm talking about the daily delivery, the spontaneous shopping, the just one more subscriptions. This isn't punishment. It's swapping fragile pleasure for sturdy safety. Step 5, build a mini emergency fund of 1 month of expenses, not 6 months. 1, that's your buffer while you scale up. And if you can't afford both yet, do insurance first for the big risks, then build the fund. If you're stable and ready to optimize, you do the upgrade version. Step 1, calculate your monthly essential expenses. Rent, food, transport, bills, family support. The stuff you can't ghost. Step 2, set your medical cover to handle a worst-case event, not an average one. Aim for a limit that would cover at least 1 major hospitalization without you selling assets. Step 3, if you have dependents, get term life that covers at least 10 years of essentials plus any debt. Step 4, check deductibles and co-pays. If you can comfortably pay a higher deductible, your premium drops. That's you self-insuring a small part to insure the big part. Step 5, once coverage is set, automate your investing. Because now, your plan has a floor. You can build the ceiling. And please, watch for the marketing tricks. They'll push fancy bundles with returns and bonuses because they sound exciting, but excitement is expensive. Protection should feel boring like a lock on your door. You don't buy a lock for the thrill, you buy it so you can sleep. Now a final story because stories stick. A guy named Imran in your office always looked boring. Same shoes, same lunch, no flashy upgrades. People joked he was stingy. Then his mom got diagnosed with something serious. Everyone expected him to disappear into debt. Instead, he stayed normal. He was stressed, but not financially shattered. His health cover handled the big bills. He didn't run fundraising marathons on WhatsApp. He didn't sell his laptop. He didn't borrow at 3% a month from that friendly lender. He just focused on care. And quietly, the office stopped laughing. That's the kind of boring you want. So when you hear insurance isn't optional, don't hear fear. Hear strategy. Hear respect for your own effort, because you work too hard to let one unlucky week erase your progress. Back to that 2:13 a.m. screen. The message is still scary. The hospital is still intense, but you're not negotiating with your future anymore. You already paid for the right to breathe. You already refused the monthly payment illusion, and that's what real adulthood looks like.